As Americans prepare to celebrate the 4th of July, is it time to buy America? Investors have called for diversifying away from the US after President Trump's trade and fiscal policies have rocked financial markets earlier this year. Traders' confidence in the world's largest economy has been shaken, but BlackRock holds firm that the US stock market is the place to be. Janet Moy is head of market analysis at RBC Brewin Dolphin. Janet, BlackRock is betting on stronger earnings from US companies. Do you see this as well?
Hi, Peter. Thanks for having me. Yes, I think that earnings growth in the US companies are still going to expand pretty nicely, particularly in the technology sector. I think there's still lots of reasons why the US is the place to be for investors. I think a lot of that has to do with the fact that the market there has lots of exposure to technology and artificial intelligence. And I think that is a very key theme for the longer term in terms of the benefit from productivity gains over time and also the profitability and scale of those companies. So I would agree with that statement. And also, despite all the uncertainty with the trade tariffs and things like that, the economy has stayed pretty resilient. And if the tax bill were to be passed, that probably will unleash more spending and investment into the US economy. So I think the outlook remains pretty good from here.
Well, we do have new employment numbers due out later today. They could ignite slowdown worries. Should we be worried about the US economy in the future, though?
So as I said, the US economy is still pretty resilient. But of course, actually, if you look at the trend in the US labor market, it has been on a modest slowdown. And I think analysts are worried about, for example, the immigration policies by President Trump that could shrink the labor force, and the tariff uncertainty would also weigh on the job creation as well. But so far, I think in terms of, say, the recent job openings data is still pretty good, surprising to the positive side. And I think analysts already kind of have baked in the slower trend of job creation. I guess if the numbers are not too bad, I think the consensus is still an ongoing expansion in the U.S. economy. So unless we see a very bad number, I don't see the Federal Reserve will be in a rush to cut interest rate.
Let's talk about interest rates now, and the timeline for cuts over the next 6 months is closely watched by traders as well as Trump. What's your outlook for the next 6 months?
Yes. So in terms of the US, I think the consensus is that 2 rate cuts by the end of the year is likely in both the US and the UK. And we tend to agree with that. We think the inflation trend in the US is pretty much heading in the right direction, despite some concern that it will probably rise over the summer. But now I think we get a bit more clarity on the tariff front. And we think that as it is, I think the inflation rise wouldn't be too acute. So overall, as I mentioned, the labor market is seeing some sign of a slowdown. I think the Fed would be comfortable to cut cautiously in this environment, but of course, don't expect steep rate cuts over the next 12 months or so if the U.S. economy is doing well.
Trump's tax bill as well, likely to add to the already elevated U.S. debt burden. Should traders avoid treasuries?
I guess this is going to be a long-term theme. It's going to flare up from time to time. It's more a kicking the can down the road story. But I do think that for the very long maturity of the US Treasury market, I think there are reasons to be cautious and potentially avoid that, given that it's more related to the fiscal sustainability issues and also the supply and demand for bonds, which is the balance is not great, which tend to create a higher risk premium. I guess the shorter end of the curve is more related to the rate cut expectations. So I'll be more comfortable with the short to mid end of the Treasury market. But I do think that we have to be prepared for a higher risk premium for the longer term Treasury market.
Finally, Janet, the dollar has tumbled in the first 6 months of the year. Do you think that this trend will continue, especially as we approach Trump's tariff deadline?
So the US dollar index has depreciated by about 10% year to date. That's a very sharp decline. And I think reflected a lot of the concerns on, say, US exceptionalism and diversifying away from dollar. I think in the near term, it's really hard to say, to be honest. I think the risk is that markets refocus on the debt dynamics of the US, and of course the tax cut bill adding trillions of dollars of debt. That is a risk that could push the dollar lower, but I think a lot of that news could already be reflected. I think near term we may actually see some counter trend rally in the dollar potentially. Over the longer term, I think there's still the case for weaker dollar because the US dollar is still overvalued on a number of technical measures. And I think that the trend of diversifying away from the US is not going to happen in a very acute way, but I think probably gradually over the next decade or so is entirely probable.
Janet Moy, Head of Market Analysis at RBC Brewin Dolphin. Don't forget, you can watch more videos on Reuters.com.